When the market gets expensive, is that a warning sign for the next 12 months in your portfolio? In today's video, we're going to look at around 100 years worth of data and talk about at different prices in the market, what can we expect from your portfolio over the next year? Now, in prior videos, I've talked about the real challenge in any version of predicting short-term stock market investments, but we do have some pretty good data, and I'm going to walk through a chart that looks at over the last 100 years or so, based on the price that you pay, what do the next 12 months look like on average in your portfolio? And I think the results are pretty surprising. Okay, so before we get started, let me walk back to what I said a minute ago, where in prior videos, I've talked about in longer periods of time, it's a bit easier to predict the returns of the market based on the price you pay, but in the short term, it's more random. Now, what I'm talking about here are these two charts. So over on the left side, you've got looks like a real scattering of dots where there's no real pattern. And if you go left to right from 8 to 26, that's essentially you're paying 8 times earnings. All the way to the right is 26 times earnings. So in other words, on the left side, you're paying a little. On the right side, you're paying a lot. And then the going up and down is the price return for the next 12 months or the next year. And you can see that's anywhere between negative 60 and positive 60. And so when you look at this chart, the dots seem all over the place, and there doesn't really seem to be much of a pattern here. Versus when you look at the 5-year returns based on the price you pay, all those dots start to move towards this line in the middle that drifts down, which is a clear number that shows us the more you pay, the lower your future expected rate of return. And that makes sense. With any asset class, we're buying cash flow. So the more you pay for those cash flows, the lower your future expected rate of return. So when you get a great deal, you get a higher return. If you pay more, you get a lower return. Okay, all that makes sense. But let's go back to this. In the short term, it's incredibly difficult to predict, and it is. But I want to take this chart with all these dots everywhere, and I want to put this in another format. So let's go here. So this chart is looking at around 100 years worth of data. It's giving us the price we pay in the market on the bottom, starting at under 10 and going all the way up to over 40. And it's saying, okay, based on the price you pay, what are the expected rate of returns over the next 1 year? Okay. Now, this goes negative 15 all the way to positive 25. These are using averages and interquartile numbers. And so what it's doing is that's just taking out these extreme outliers. And what we see is similar to the 5-year numbers. The more we pay over on the right, the lower your average rate of return. And then if you go all the way over to the left, the less you pay, you get a higher average rate of return over the next 12 months. Now, why did that other chart have dots everywhere? Because with each of these dots or averages, there's this big range of returns on all of them. Now, of course, when you go over to the left side, you have an average rate of return of around 12, and you still have a range. You go to the right side, you have an average rate of return, and you still have a range. So this is not the number you'll get. This gives you an expectation of an average, and then the range comes from the average. But the pattern is still clear. Whether we're talking about long-term numbers or whether we're talking about short-term rates of return, the price that you pay matters. And so when you're looking at your portfolio, as I always say, know what you own and know why you own it. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.